How does the CRA audit foreign businesses? The Canada Revenue Agency, CRA, audits non-resident businesses more frequently than many expect, especially US companies selling goods, software, digital services, or consulting to Canadian customers. Because foreign sellers often misunderstand Canadian tax rules, the CRA monitors cross-border activity closely to ensure proper GST, HST registration and remittance. Understanding how CRA audits work helps foreign businesses prepare documentation, avoid penalties, and maintain compliance while expanding into Canada. CRA audits are increasing for non-residents. As e-commerce and digital services cross borders more easily, thousands of US businesses now sell to Canadians without realizing they may owe GST, HST. The CRA has modernized its audit tools using import data, bank records, marketplace information, and platform reporting to identify foreign sellers who may be non-compliant. Audits often begin with a simple request for information, but can quickly escalate if the business cannot provide documentation. Why the CRA initiates audits? The CRA conducts audits for several reasons, not just for suspected wrongdoing. Sometimes the goal is to verify paperwork or ensure proper registration. Other times, audits arise from revenue discrepancies, import activity, or data shared by third parties such as Amazon, Shopify, or Canadian payment processors. Foreign businesses should assume that the CRA has access to detailed cross-border sales information. Here are the most common triggers for CRA audits of foreign businesses. Import records linked to a non-resident business name. Amazon FBA or Canadian warehousing activity. Large volumes of digital sales to Canadian customers. Failure to register for GST, HST despite taxable supplies. Mismatched or missing GST, HST filings. Customer complaints or refund issues. Any of these may cause the CRA to request documentation or launch a full audit. What the CRA requests during an audit. CRA auditors typically ask for sales records showing Canadian transactions, copies of invoices and GST, HST calculations, import documentation and customs entries, proof of the business's residence and operations, contracts with suppliers or fulfillment centers, evidence of digital service delivery. Foreign businesses often struggle because their accounting systems are not structured for Canadian tax reporting. Remote audits are common. The CRA is accustomed to auditing non-residents remotely. Auditors communicate through email, secure portals, or phone calls, requesting scanned records instead of in-person visits. Businesses must respond promptly, even when operating outside Canada. Failure to reply may result in assessments based on the CRA's estimates, which can be significantly higher than the actual liability. Assessment and adjustment. If the CRA concludes that the business failed to collect GST, HST when required, it issues a notice of assessment. This document lists tax owing, applicable penalties, interest accrued. Foreign businesses cannot transfer liability to customers after the assessment. The business must pay the amount directly. If the CRA determines that a business incorrectly claimed input tax credits, those credits may be reversed, resulting in additional tax payable. How long CRA audits look back? The CRA typically reviews 4 years of filings, but for non-residents or cases involving failure to register, the audit period may extend back further. If gross negligence is suspected, the CRA may review up to 10 years of activity. Non-resident sellers must therefore maintain robust records even if they believe Canadian sales are minimal. Resolving CRA audits. Most audits end with acceptance of filings, adjustments to tax due, formal assessments, payment arrangements. For businesses facing large assessments, payment plans may be available. The CRA also allows objections when the taxpayer believes an error occurred. A practical example. A US e-commerce seller ships products directly to Canadian customers. The business assumes that because it is not physically located in Canada, GST, HST does not apply. However, import records show that the business acted as importer of record on numerous shipments. The CRA initiates an audit and determines that the business should have registered for GST/HST 2 years earlier. The business is assessed tax on all taxable supplies during that time, plus penalties and interest. Without proper records, the seller struggles to reconcile sales and fulfill CRA requests, leading to a higher assessment than necessary. Final thoughts. CRA audits of foreign businesses are increasingly common, especially as cross-border commerce expands. US companies selling to Canadian customers must maintain organized records, understand registration obligations, and respond promptly to CRA inquiries. Preparing in advance reduces stress and minimizes the risk of penalties or incorrect assessments. If you'd like more insights delivered in the same straightforward style, you can explore our website. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.